And we will continue and we will meet our next true expert. He successfully founded several fintech enterprises and gained in-depth knowledge of high technology. He is the founder and CEO of quantumrock, which is an AI asset tech company that differentiates through an innovative AI platform. They call it the Industrialization of Alpha Generation. And now let's learn more and welcome the next online speaker, Stefan Tittel.
Yeah, thank you so much. It's a pleasure to be here. Actually, I listened most of these sessions before, and it was quite interesting, and I learned a lot. And I hope to add also some more practical views to those discussions right now. So let's start with a pretty bold statement, which is basically saying AI is the future in asset management. And probably you're aware of publications like this, and I think there's a lot of truth in it. For several reasons. A very simple one is you can view the capital markets as a battlefield. And as soon as one group emerges on the battlefield using automatic guns, it's just a question of time until the others have to comply with this tendency and also move to the higher grade weaponry. Or to put it in another word, as a participant in the capital market, we, all of us, we are obliged, it's a must to leverage the best advantages we can get and use the highest grade technology, which is there, namely AI. So I think the application of AI from a tech point of view is an imperative for the markets. But there are more specific reasons in asset management why artificial intelligence and machine learning is the future. Let's have a look at what type of challenge the market actually faces. I mean, we have around 127,000 regulated open funds out there. With investments of close to 70 trillion US dollars. So it's a big market, it's a big thing. And investors ultimately look for a very good risk-return ratio for good returns according to their beliefs. However, you have invested in products, I have invested in products, we all have invested in products which fall short to those expectations. And I think as he said, truth is that the majority of products in the market does not fulfill the expectations the investors have. They might fit the thesis about a certain allocation in stocks, in high-tech stocks, or in emerging markets, and so on. But with regards to volatility, drawdowns, and return, many does not meet what the investors want. And there's a fundamental problem to it. And especially in our keynote, we heard a little bit about this type of problems. We have more and more information in the markets, increasing flood of data needs to be analyzed. Everything is more fast-paced now. And it's very difficult to keep up to those ever-changing and faster-changing markets. And the ultimate outcome is also mentioned in the keynote this morning that so-called alpha sources are very short-lived. They're eaten away by the market as soon as they pop up. However, what shall we do now? I mean, on one hand, we have those many funds which have a good reason to exist because investors choose them according to their liking. On the other hand, for them, it's getting more and more difficult to perform accordingly. We believe AI is a good answer. And let's have a look what AI, as we employ it, could do in that sense. First, you can process more data faster. And I want to object to the notion in financial markets you don't have enough data to analyze. It's just not the truth. I give you a simple example. Let's look at the S&P 500, 500 stocks, a time series for 30 years for each of the stocks. You have minute or even tick data. It's a vast amount of data already. Combined with fundamental factors, let's take the best 120. And now you also calculate the movement of the stock individual to each other. You get to a universe of several hundred million of data points. it's very difficult to analyze this by an Access database or by Excel or by any other means. So machine learning and artificial intelligence just perfectly makes sense in this universe as well. But most important, also we use artificial intelligence to detect those temporarily market irregularities, which are the source for alpha. And I believe, our company believes that with machine learning and AI, you can find those alpha sources faster. And when you have an integrated process, turn them into an investable product in a very time compressed fashion. And thus you will be able to use the time in which an alpha source is still there and not eaten away by the market, you can use to the best. And ultimately, when you utilize AI in such a way, you can actually stay ahead of alpha decay in the market. So this is a generic concept also we are following on. However, what is the correct answer for the problems I mentioned earlier? Now knowing that AI could provide the technological means, I believe the answer is not to create just another fund, an AI fund, and make people invest into it. It make you get rich, or a certain group of people get rich. But as you have seen before, we have 127,000 funds out there which were chosen for good reason. And those investors, family offices, institutional clients, and so on, will not just move their assets to an AI or a group of AI funds, because they also have to comply with their investment principles, and it's just not possible. So we believe, and we are going back here also to some research from Bridgewater, already dating back to 2005, that not a fully new product is the answer, but adding alpha to specific existing products to allow an investor and family office, an asset manager and fund manager to stay within his allocation scheme, let's say European stocks above a certain size with a certain momentum, but specifically add a certain alpha, we call it alpha add-on, to his already existing product and just make it better. And what I just described to give for some investors, a good pill for pain relief, and for other investors, a more blue kind of pill for better performance in certain environments. Why this is the answer, it was in the past very difficult to provide it on an individualized basis, because you would need to go into an institutional client, with a team of consultants, analyze what he's got on his portfolio and his fund and what his allocation scheme is and so on. And then you need to go back and work a long time with research and trial and error and come up with a certain pain relief pill, or an alpha add-on. However, by the time you get back to those clients, the alpha source is already eaten away, as we've heard before. So the real issue is to be able to create in a very industrialized fashion, tailor-made pain pills, alpha add-ons for investors, and allow them ahead of alpha decay to put something in their portfolio which either provides protection or higher return, or just smooths down volatility or increases the Sharpe ratio. So that's also what we stand for. We have spent the better part of 8 years developing this mechanized, industrialized way to generate so-called alpha add-ons for all types of clients. And I agree with many of the presenters before, and you got the impression already when you talk about machine learning AI, it's very difficult to apply successfully in asset management and financial market. I can relate to our own experience. It's absolutely true. So we needed around 8 years to develop the technology stack I just mentioned, not an AI fund, but an assembly line, an automated assembly line fully based on AI to create tailor-made quant models. Let's put it this way. By now, our approach is patent pending. We had a lot of impetus from research from universities, but of course, the major part is developed on a proprietary basis from our AI and machine learning experts. When we look at what we got, it's a combination of several technologies compiled into one platform. Yes, you do predictions. Yes, you do once a model is applied to a certain investment product. It's constantly retrained. Yes, it needs to be adaptive. Speed plays a role, but one major part is also to avoid overfitting. So I would say 30% of our development capacity was dedicated to specifically use also machine learning approaches to avoid overfitting when building and creating a model. We believe that with such an approach, you can really change the world of asset management. And I also noted, listening to the presentations before, there's this slide. It's like a war of beliefs. Is AI good, or is it not good? Is it the future? Is it better? Actually, I don't care. I don't care. It's a tool set which we need to use to get better results, to be not on the side of people having the disadvantage of not using it. Our experience, though, is it just works well in the combination of humans and the technology. We call it a symbiosis. So in our case, and you see it here on the left side, we have the data input. The data input can be, and in the most cases, it is just a portfolio by a large institutional clients or family office or a certain fund and some, let's call it constraints. In other cases, we can have also one of our capital market experts raise a thesis about certain factors in relation to certain underlyings. And based on this, our AI machine learning platform does the computation and usually develops or identifies up to thousands of very fragmented investment opportunities and then compiles the best into what you would call a trading strategy or an investment product. So I think the edge is to have it as an integrated approach to allow us to deliver such products in a very short period of time. And I want to give you also two examples how this could work out. The first example of such an alpha add-on, it was originally developed for a large Southeast Asian bank. As many of the institutional investors, they have a huge treasury or bond portfolio and are very worried now in times of rising interest rates that their portfolio might suffer. And I mean, this fear or this worry is very justified. And based on their constraints and the data input, our platform identified two sources, or actually four, combined into strategies, four sources for short alpha or generating alpha by trading short US treasuries in a very interesting way, providing on one hand an enhancement for any type of treasury and bond portfolio, but on the other hand also giving a protection. And here's how it looks. For example, you have and here we look at the live numbers of the specific client. We have an average return, without the risk I just mentioned, of around 4%, can be increased or could be increased to a little bit more than 6%. And also the Sharpe ratio increase, volatility goes down, and also the maximum drawdown goes down. And here you see also the respective time series for this. And please don't get fooled by the low value of the numbers here. We are talking about big portfolios, and 10 basis points, 50 basis points in the field of bond and treasury holdings means a lot. It's a big difference. So this was the first example. And the second example is called VSOP. It's also our proof point for what I explained with our platform. It's an absolute return program, which is actually a combination of the most common alpha add-ons we found in the past. There are more than 20 major ones, and also more than 100 fragmented small installations as well. So it's a program, it's running already for 6 years in real money. So it's not back tested, it's not theory, it's really out there. And what you see here, it's this graph. It's the outperformance against a peer group of other absolute return funds. And I mean, when you look at this 6 years, not a single losing year, also in various environments. So I think it speaks for itself and shows how with the application of AI and machine learning, consistently you can be able to be ahead of competition and ahead of the market. And by the way, this is also the program which was just recently also implemented in the Plexus index, which was named earlier. And I think also in March, we showed a very decent outperformance to the index itself. Again, here, an idea how VSOP, as a combination of alpha add-ons added to a so-called balanced portfolio of a family office or large institutional clients, what the improvement would be. Sharpe ratio increases, the average annual return increases slightly. However, most importantly, the maximum drawdown is going down, which is in today's time very important for investors. With that, I thank you for your attention. I hope you take away the main points, which is AI machine learning as a means to efficiently create trading strategies and investment products to find new sources of alpha is the key. Thank you.